The accounting for gift cards is somewhat unique. We've got a couple of issues. The first being that at point of sale, when someone actually buys the gift card, a company cannot recognize revenue. So if someone walks into a store and pays $200 cash for a gift card, the company can't say, oh, we have $200 of revenue. And the reason is that that person has not redeemed the gift card yet. At some point, so they give it to a family member, and then that person comes in a month later and says, hey, I want some of that merchandise. And then the store is obligated to give that merchandise. So when the store initially receives the $200 cash for the gift card, they're actually going to recognize a liability. So they're going to debit cash and they're going to credit a liability to show that they have an obligation at some point in the future to provide goods or services to the person holding the gift card. Now, what if the person doesn't redeem all of the gift card? What if, so we've got a $200 gift card, but what if they only redeem $170 worth of that? They don't spend the entire $200. What happens to that remaining $30? Well, there's a couple of issues. Number one, some companies will have an expiration date on the gift card, and it'll just say, okay, look, we've got 1 year expiration. So if at the end of 1 year, if you haven't spent the full $200 and you've instead just spent $170, well, you just lose that $30. The gift card is done, and the company would just recognize this $30 as revenue. So the company would just basically pocket the money and not have to provide any goods or services for it. Okay, so this is called breakage, by the way. Breakage is when there is a failure to redeem part of the gift card. Okay, and companies go to great lengths to try and estimate what will be their breakage rates and so forth. So what about certain states? You might have heard of escheatment before. What about if the state is a state that has escheatment laws? Escheatment laws are basically, they relate to unclaimed property. So unclaimed property would be, this would be a case where if the person paid $200 for the gift card and they didn't use $30, this would be a case of unclaimed property. Now, some states will have these escheatment laws which say, look, if you don't spend that $30, that escheats to the state. What that means when we say escheats, it just means that $30, instead of the company just saying, oh, well, that person never spent the $30, I guess we don't have to do anything, the company actually has to pay that $30 to the state government. So this depends on a state-by-state basis. Are there escheatment laws? So if there are no escheatment laws, then the company just says, okay, well, I guess they never spent the $30. Hey, great. But if there are escheatment laws, that money can go to the state government. So you see that this can get a little complicated. So let's go through an example. Let's say that Walmart sells a $100 gift card for cash, and the gift card is going to expire in 1 year. I don't know if Walmart actually has an expiration date on its gift, but let's just assume that it does. So 1 year from the date of purchase. So if the customer doesn't, or the person with the gift card doesn't spend it by then we're going to have to discuss what to do with that. Okay, so first, the sale of the gift card. When Walmart sells this gift card, they're not going to recognize revenue. Instead, they're going to debit cash for $100, but they're going to credit deferred revenue or accrued liability, they're going to credit deferred revenue, accrued liability, unearned revenue, some kind of liability account. So this is a liability. And because we've got a 1 year expiration on this gift card, this would be categorized as a current liability. So why are we crediting a liability instead of just crediting revenue? Because Walmart has not done anything to be entitled to the revenue yet. Someone someday might show up with the gift card, like it's, let's say 3 months, and says, I want to buy a garden hose. And they say, okay, now they have to give them a garden hose. So Walmart has incurred an obligation to sacrifice resources at some point in the future. So that's why this is a liability. But also, let's say now that the customer does come back, let's say a month later or something like that, and they use the gift card and they purchase merchandise for a retail price of $70. So let's say that's the price they pay for the garden hose or whatever it is they buy. And then the original cost of Walmart of acquiring that garden hose was $55. How do we account for that? Well, now what we're going to do is we're going to back out of that deferred revenue $70 and recognize $70 of revenue. because now it's no longer been deferred because somebody can't. Walmart satisfied their obligation. So by debiting deferred revenue, you're reducing the obligation, and then you can credit revenue, which is going to affect the income statement. Okay, but then Walmart also, they got rid of some inventory. Okay, I don't know why I put 30 here. It's actually, let's see, it's $55. Okay, so they're going to debit cost of goods sold for $55 and credit inventory for $55. Okay, so this is so here was the transaction, or here's the journal entry for Walmart when they originally sold the gift card, and then this is the journal entry when someone comes and redeems the gift card and says, I'm going to buy $70 worth of merchandise. Okay. So what if, so we see that there was a $100 gift card initially, but they only spent $70. Let's say they never spend the remaining $30. Okay, they don't, so we have breakage. Remember, breakage is there's a failure to redeem portion of the gift card, and so let's say they didn't spend $30 within the 1 year, because there was a 1 year expiration date. So they haven't spent it. So the money goes away. Now, how do we account for that? Well, does that state have escheatment laws or not? So if that state does not have escheatment laws, then what is going to happen is Walmart is going to debit deferred revenue for $30 and then credit revenue for $30. They don't have to, so this is basically a similar journal entry to right here, only they don't have to debit COGS and credit inventory because they haven't gotten rid of any inventory. They basically recognize the remaining $30 on the gift card as revenue. It's like, okay, time's up. Person didn't spend that $30. We're going to recognize it as revenue, and we don't have to recognize any cost of goods sold because we didn't sell anything. Okay, that's if the state has no escheatment laws. Now, if the state has escheatment laws, then that $30 has to be paid to the state government. Okay, so that is going to escheat to the state. So Walmart is going to say, okay, now we have to credit cash for $30, and we're going to debit deferred revenue for $30. So in either case, if there's no escheatment laws or whether there are escheatment laws, in each case, you have to reduce and get rid of this deferred revenue because it's no longer been deferred. But when there's no escheatment, the company just recognizes revenue for the unused portion of the gift card. When there is escheatment, they have to credit cash to recognize they're going to pay that money out to the state government because the unclaimed property of $30 is going to escheat to the state.